We're going to take a look at a couple of more interesting growth and income opportunities now along the lines of stock companies with Todd Bunton, our growth and income stock strategist. You've got a nice little mix here of a restaurant company and a bank.
And a bank, yeah.
So let's talk about the restaurant company first, Brinker International.
Yeah, Brinker International, EAT is the ticker symbol. We probably know them best for Chili's, their Chili's brand, which is they have over 1,500 locations. They also own Maggiano's Little Italy, which has about 44 locations.
Around Chicagoland.
There are some here in Chicago, yeah, and throughout the U.S., really.
Okay.
And that's a growing little chain for them. But the company laid out an ambitious goal back in 2010 to double earnings per share within 5 years.
Wow.
And here we are in 2013. The company appears well on track to meet that goal, maybe even a year early, management said in their last earnings report, actually. And they've done that through a mix of positive same-store sales growth, but also expanding profit margins. So the company is really focused on efficiency, on cutting costs, and that's really translated into solid double-digit earnings per share growth year over year. And that was on display in the last quarter. Even though the company reported a slight decrease in same-store sales and overall revenue was flat, the company still delivered a 20% earnings growth.
That's big.
Yeah, and that's due to, like I said, lower cost of sales. The company installed new kitchen equipment to improve efficiency. So very shareholder-friendly company here, very focused on growing earnings, and they've only missed earnings, the Zacks consensus estimate on earnings once in the last 11 quarters. So they have very solid earnings momentum. Analysts actually raised their earnings estimates for both 2013 and 2014 after the last earnings beat back in April, and it sent it to a Zacks rank of 2, which is a buy rating. And if you look at consensus estimates, analysts expect 19% earnings per share growth this year, 18% growth next year. So the company continues, analysts expect the company to continue delivering solid double-digit earnings per share growth.
Yeah, what's more interesting to me, though, being a restaurant company, is that they're able to manage their food margins, their food costs, in such a way, given all the fluctuation going on there.
Right, and and that's something that actually benefited them in the last quarter. They did see a slight decrease in food cost in some of their products, and chicken wings was actually one that that was one that actually increased in price. So that did hurt them. But they've been able to kind of shift the menu towards the higher margin food products too, which has helped. And they're actually going to roll out pizza soon too, or I think they have in a few locations already. So they're always looking at ways to improve those margins.
Right.
But along with the solid earnings story here, you get a dividend that yields 2.1%. The company, they began paying a dividend in late 2005. Since then, they've increased that at a compound annual rate of 17%. So very shareholder-friendly company. You get a solid yield to go along with that earnings growth, and you're getting all that at a really reasonable price. They trade about 14 times forward earnings. The industry median is 19 times, so it is a discount to that. There could be strong total return potential for Brinker over the next couple of years.
All right, from pizza to banks.
Yeah.
You're looking at Wesbanco, WSBC. This is a bank holding company, right?
Yeah, that's right, and most of them are. And they operate people would know them as Wesbanco in West Virginia, Ohio, and Pennsylvania. And that's actually right around the Marcellus and Utica shale regions, which is the booming natural gas market. So analysts expect that to be a huge tailwind for this company over the coming decades, really, as population growth increases and those people are well paid and they're going to take their money to a bank, and deposit it there, and you'll see solid loan growth along with that. But the company has recently came off a very solid earnings beat, and that was driven by an increase in the net interest margin, which is basically what they take in interest on loans minus what they pay out in deposits. And if I'm sure you might be aware that interest rates have been rising, at least on the long end of the yield curve, and that's actually a net positive for banks because that means the spread between what they take in on loans and what they pay out on deposits is widening, and that means more money in their pocket. So they're going to stand to benefit from that, and also from improving credit quality and loan growth, like I talked about. So very, very solid industry fundamentals here, and like I said, very solid company-specific fundamentals because they're in a growing population. So analysts expect solid growth for this company over the next several years. They actually have consistently increased their estimates over the last several quarters. As you can see here, I brought with me the price and consensus chart. And you can see consensus estimates have steadily risen over the last several months for both this year and next year. Sent it to a Zacks rank of 1, which is a strong buy rating. So very good earnings momentum here. very good income as well. They pay a dividend that yields 2.9%. Very solid there. They did cut their dividend in half back in 2009, along with a lot of other banks, obviously, during the financial crisis. But they've steadily increased it each year since 2011. I'd expect strong dividend increases over the next couple of years as long as that bottom line continues to grow. And you're getting all that at a very reasonable price. They trade at 1.8 times tangible book value, which is in line with the industry median, and about 1.0 times total book value. So could be some value to go along with that. Could be strong total return potential in this name over the next couple of years as well.
Yeah, you talk about the yield curve. It's going to be interesting to see what happens once that yield curve gets to a situation where it's nearing inverting.
Well, it's kind of doing the opposite of that. It's actually steepening now because the
Right.
short end of the yield curve is staying low, and the Fed is going to keep it that way. But the long end, the 10-year and out, that's been increasing. So
So you don't see any fear of that in the near term anyway.
No, and Bernanke and the Fed, they want to suppress long-term interest rates, but it seems like the market's saying otherwise.
Yeah. Okay. Do you own either of these?
I do not.
All right. Check out other stock picks, stock picking strategies as well at Zacks.com. If you're watching this video out in syndication land, get on over to the homepage and you can link to them from there. With Todd, I'm Terry Ruffalo.